SPACs are really popular with retail investors right now, but do you know how they actually work? In this video, I'm going to be explaining to you exactly what the SPAC process is from start to finish, so make sure you watch to the end. What's going on, guys? It's Dylan from I'm Invested. I'd really appreciate it if you could smash that like button and hit subscribe, as it helps the channel out so much. Now let's get into the video. A special purpose acquisition company, or SPAC, is a public company that is created with the sole intention of acquiring private assets. There are a number of ways to use a SPAC, but the process of creating, funding and buying the private asset is basically the same, no matter what the goal of the SPAC. While the end result of a SPAC will be a publicly traded company that owns formerly private assets, the process to achieve this result takes place in a number of stages. If you want to know more on how a SPAC is formed, funded and operates, then watch to the end of the video. The first stage is for one or more of the pre-IPO sponsors to pay for the initial setup and commit to the SPAC sponsor capital, which is usually 5.1% of the planned IPO proceeds. The cost to set up the SPAC and conduct the first pre-IPO will be around $800,000, with 5.1% of the planned IPO proceeds as a sponsor capital added to that amount. Around 2/3 of the setup costs need to be paid prior to the IPO, while the last third will be covered by the IPO proceeds. Setup costs will be refunded to the paying sponsor from the IPO proceeds. In stage 2, the SPAC will be incorporated as a company, typically an LLC or limited liability company. In stage 3, the company will apply to the SEC for an S1, also known as the prospectus. This will detail the SPAC shareholders, board members, acquisition strategy and statutory information. In stage 4, the pre-IPO sponsors are now able to deposit the necessary funds into the SPAC's trust account. In return for their pre-IPO investment, the sponsors receive founder shares. Founder shares will be converted into listed common shares on the day of the IPO. Stage 5, and the S1 that was filed with the SEC gets approved, the SPAC is now ready for listing at a stock exchange and for IPO, provided that is, the sponsor capital has been paid into the SPAC's trust account. Stage 6, and investment bankers or other investors will organise roadshows to help promote the SPAC. The goal of these roadshows is to attract large institutional investors to participate in the IPO of the SPAC. The CEO and CFO of the SPAC usually participate in these roadshows, together with a high-ranking manager from the underwriting bank. Stage 7, and as a result of these roadshows, institutional investors or similar are now ready to commit capital to buy shares at the IPO of the SPAC. Stage 8, and the SPAC will now be listed on the New York Stock Exchange or NASDAQ by the underwriting bank. It is now a publicly traded company. Stage 9, the morning after being listed on a public exchange, the SPAC will have its IPO. In stage 10, institutional investors will buy shares in the SPAC via the IPO process. Their funds will be held in a trust account. Shares will also trade on a public exchange, although until there is news flow, trade volume is likely to be muted. In general, the value of the shares will be $10, although this can be modified. And most SPAC IPOs will include a partial warrant with every share. Stage 11, the board of the SPAC will begin to pursue possible acquisitions that are in line with the company prospectus. If another goal was part of the prospectus, such as the acquisition of a specific company, the board will begin that process. In stage 12, the SPAC will acquire a private company or companies, or parts of them. These target companies must be private and not listed on public exchanges. Stage 13, and the target company may be acquired as a mix of the following 3 ways. Number 1, cash payments are made to the sellers of the target company. Number 2, fresh shares in the SPAC are issued in exchange for ownership of the target company. And number 3, asset-backed financing. In stage 14, after the target company is acquired, it or they will be merged into the SPAC, which is a publicly listed company. This process is called a reverse merger, and it makes formal. The final step is also referred to as despacing or business combination. Once it is complete, the SPAC no longer exists, and it is a publicly traded company. I hope this has cleared the process up for you. Please drop me a like if you enjoyed the video. Consider subscribing to the channel if you enjoy this type of content. Leave me your thoughts in the comment section down below on what SPACs you're involved in. This is I'm Invested. I'm Dylan. You all have a great day. Peace out.